Welcome to the Purposeful Wealth podcast, brought to you by Wells Gibson, where we talk honestly about investing, financial planning, and what it really means to build long-term wealth. I'm delighted to have a very special guest with me today, someone whose thinking sits at the very heart of how we at Wells Gibson approach investing. James Baker is a director at Albion Strategic Consulting, a firm that works with some of the most thoughtful, client-focused financial planning firms in the UK. Albion supports firms like Wells Gibson with our investment philosophy, portfolio construction, due diligence, and the kind of rigorous evidence-based thinking that keeps us honest and keeps our clients on track. James and I work closely together, and I can tell you conversations with James, they do have a habit of clarifying things. He has a rare ability to cut through the noise and to get what actually matters when it comes to investing. So James, it's great to have you with us. A warm welcome to you.
Thanks very much, Jonathan. Wow, that was quite the introduction. There's a lot to live up to, so I'll do my best.
I'm sure you will. James, listen, for listeners or viewers who might not be familiar with Albion, how would you describe what you do in simple terms?
Good question, Jonathan, and it's one that I have worked on for 10 years because I'm sure no matter how many times I tell my parents, my wife, what I do, I'm not sure they ever fully get it. But so Albion is what you traditionally call an investment consultancy firm. We like to think of ourselves as much more than that. We are, an investment research house. We're really passionate about investing, and we've been in the UK now for around 25 years. My good friend and team member Tim Hale founded us around 25 years ago. We've been very fortunate to fall into the what we call systematic side of the industry, and I'm sure we'll talk about that in a little bit. But Tim set us up 25 years ago because there was this real lack of kind of investment rigor and investment science happening in the UK, and it wasn't necessarily anyone's fault. It was just that we hadn't quite got there yet. We were probably 10, 15 years behind the States where Tim was working before, and Tim really came back to the UK to be with his partner and start raising a family, and went out to the working world to try and help support advisors. And we're sort of like, wow, we're kind of a little bit behind here. We're kind of a bit old school. We're picking funds based on, commission or, beauty parades, the next best trend of the day. And there's not a lot of rigor and science going on in the background. And he had been used to that in the States with his previous job. So he set up Albion to partner with financial advisory firms like Wells Gibson and others to really bring that rigor and science and process into their investment proposition, and really start focusing on, what is going to give our clients the best chance of success. So that's what we started as, and that's what we do today. We partner with 75 or so firms, mostly in the UK, but a handful abroad as well, to bring the definition of their proposition, help them govern it through time, and help them communicate it to their own clients, much like you're doing right now.
Yeah, okay. You said 75 firms. So that seems a heck of a lot. I mean, what sort of value of, if you were to add up or total the value of the assets or money invested in pensions and investments, for instance, what sort of value are you looking at there, James?
Yeah, it's a great question. I mean, we do an annual survey for clients where we ask what their current AUM is. We haven't done that for a couple of years now, but the last estimate was about 25 billion. So that was 2 years ago. So with the firms that have joined in the last couple of years and some pretty favourable markets in the last couple of years, I would guess 30 to 35 probably.
Goodness, yeah. Yeah, quite incredible. Huge responsibility, isn't it? Huge responsibility.
It is, and when we get to those numbers through from the survey, we really do. It's a kind of pinch your arm moment of like, wow. I mean, this is a huge responsibility, and we take it very seriously.
Yeah. And for our viewers and listeners, James just mentioned a 3-letter abbreviation called AUM there, and that means assets under management. And in our sector, we sometimes you hear assets under management or funds under advice or funds under management. It seems to be so many terms used for the same thing, really. Most of these firms, James, you're working with, they share a strong financial planning ethos. I mean, what do you find that these firms typically have in common?
Really good question, Jonathan. And crucially, financial planning focus is a great place to start. And investing is just one part of the financial planning process, as you well know. It's an absolutely crucial part. Like, none of the rest of it works without the engine. So you've got to make sure the engine is fit for purpose. And you can almost think of it as like a car. But, none of the rest of the car can function without the engine. But, it's not like the driver has to go in and be able to explain exactly how the transmission works, about how the fuel injection works and all that good stuff. You need to know it's reliable and works and is going to be there for you through time. But it's not the be all and end all. And financial planning focus is absolutely key, like robust cash flow planning, really focusing on those end client outcomes. And I think a big difference between not just Albion clients, but firms that really are in that systematic space versus perhaps on the more judgmental side of the industry, which is really catered to different types of clients. But your focus is on best chance of success, and that is really subtly different from largest amount of success in the smallest amount of time, because they're very different things. If I were to build a portfolio to beat everyone in the next year, it would look extremely different from a portfolio that we build with our clients at Albion, because that's not what we're trying to do. We're trying to match those client liabilities through retirement and make sure they're comfortable, happy, and can do what they want throughout the rest of their lives. And that's the focus of our clients.
Yeah, and it seems to be certainly from my awareness of other firms who I know use your own services, that they're very much putting the client's life at the very centre of their conversations with them, the client's life very much at the centre of the planning. And it just happens to be that what's powering their plan and their financial future is a sensible approach to investing. And it seems to be the if you like, that sort of common denominator. And I mean, I regularly saying to clients that we wear a risk manager's hat as opposed to a performance manager's hat. And yet, by wearing a risk manager's hat, our performance is nothing to be ashamed about. It's leading the way in so many ways. And but what would you say differentiates firms who truly believe in systematic investing from those who advocate an active or judgmental approach to investing?
Yeah, so risk managers hat on. That's one of the things we actually start with throughout our induction process with new clients at Albion. And it's a really key starting point for understanding what a systematic approach to investing is. And a systematic investment manager essentially looks at market prices today and says, what does it tell me about the expected return in the future? What does it tell me about the risk embedded in that price today, about the future? We're not really interested in the past. The past is important, and it obviously feeds into decisions and data and number crunching and whatnot. But ultimately, the past is the past. The future is really what we ought to be building our portfolios for, and that's a systematic approach to investing. We say, what does the current market price tell us about the future? A judgmental approach, on the other hand, is different to that. It says, I've got some assumptions about these companies or this manager or this region or this geography, this sector. I've got some assumptions and I think they're going to do X next year or Y in 5 years' time. And I think they're going to be better than this sector or this company or this region. And they'll make up their own assumptions and then almost compare it to the market price and say, well, I disagree with the market price. I'm going to go and do this because my model, my extra skill set disagrees with the market price. And so I'm going to go and do that. And the challenge you have over on the judgmental side is you've got millions of extremely intelligent, highly qualified, highly paid individuals doing exactly the same thing as you are. And they're all trying to outcompete each other and come up with better assumptions, better models, better machine learning, better AI, whatever it might be, to feed into their forecast for the future. And the beauty of a systematic approach is you get to benefit from the equilibrium, the midpoint, all of those different models. Some of them will say buy this, some of them will say sell that, and ultimately will arrive in this middle point, which is the current market price. And you, as a systematic investor, you just say, listen, I'm not gonna do that. I'm not a professional like stock picker, or I don't have these really sophisticated models. I'm gonna piggyback and benefit from the aggregate view of all others in the industry. And it sounds like that actually sounds like quite lazy or whatever. There's still a huge amount that goes into systematic investing. It's not as simple as just, buy one thing and forget about it. Far from it. But ultimately, you've got this really efficient thing driving your outcome. And that's human ingenuity. It's capitalism. And as long as that survives and thrives throughout the rest of your life, you're going to be in a pretty good place.
Yeah, totally agree. And I think that was very much, the starting point to systematic investing, was that sense that actually it's capitalism. It's capitalism that creates wealth, and you and I know capitalism isn't perfect. It does have its challenges, but it's probably the best of the other economic models. But it is capitalism that creates wealth, that the markets themselves do a pretty good job of giving investors a return over time, and that volatility and return are related. And really the only free lunch that we have when it comes to investing is diversification. Let's not having all of our eggs in one basket. I suppose my question to you, James, is why is it so important that that an investment process begins with clearly defined beliefs like the ones I've just mentioned there?
Yeah, well, if you don't have beliefs as part of your investment philosophy, as part of your construction process, then you've really got nothing to anchor to, nothing to measure yourself against through time. And I think that's where even the systematic space does fall down in the industry. And that's where, Albion really pride ourselves on being some of the deep thinkers and whatnot in this space, is that, based on what I've just said there around systematic and judgmental, a lot of people think, you can just go out there and pick, the cheapest index fund from, either Vanguard or a L&G or whoever it might be, a Fidelity, and, maybe pick a bond fund or hold some cash alongside it if you need to, and, rub your hands together, job done. And it just is so, there's so much more to it than that. I can't begin to describe how that, that is, it's going to give you a pretty good outcome, but there is so much more to it than that. So it's about, what are we trying to achieve for our clients? What are the beliefs that we hold based on the evidence, crucially, that will allow us to achieve that goal? And how do we measure the portfolio through time to make sure we're achieving those goals and constraints and are in line with the beliefs that are underpinning the portfolio? So if you don't have beliefs, the real danger is you get lost through time. You get lost picking another low-cost fund just because someone shaved a basis point off, and you save your clients 1 basis point, but all of the trading and time out the market you do to get there costs them 30-40 basis points. Or you go to an industry conference and someone talks about something really exciting and compelling, and because you don't have really clearly defined beliefs and goals, you end up making wholesale changes to your client's portfolio just for the sake of it. So you have to have beliefs. They really are. They're the starting point of a proposition.
Yeah. And starting with that aspect, starting with this idea that it's capitalism that creates wealth. I mean, James, what are we actually buying when we invest?
It's a great question, and I'll stop saying it's a great question after every question, but but this is a great question.
I hope they're great questions.
Yeah. Well, it is a great question, and because people don't often think about that, they might buy a fund or a selection of funds and really not think deeply about what's going on under the bonnet. And I think it's part of the challenge you face now with sort of so many product providers out there, is that end clients almost want to see lots of line items on their kind of platform or on their fact sheet, because it makes them feel like they've got all of this good stuff. The reality is funds, open-ended funds, the ones that our clients will be mainly using in their portfolios, are combinations of stocks on the equity side or bonds on the fixed income side, or a mixture of the two if you're talking about, say, a multi-asset fund. Now, obviously, there are more investment opportunities out there, hedge funds, private equity, structured products, digital assets, etc. But focus on the big two traditional assets. When you buy an equity fund, you are buying a small share in each one of the companies listed throughout the world. I'm talking specifically here about index funds, not about the active side. I mean, it's sort of the same principles, but you're buying a smaller subset of the overall marketplace if you go down the active route. But if you buy a broad market equity fund, you're buying a small share in the future earnings of Apple, of Nvidia, of Amazon, of Tesla, of Microsoft, all the way down to your mid-sized companies, your small companies, and your micro companies, most of which we probably won't heard of, but you buy a small slice in each of them. The proportion that you buy is equivalent to how big those firms are in the marketplace. So you're going to own more of Nvidia, Apple, Microsoft, Amazon than you are of, some of the smaller firms out there. UK, for example, we're a smaller market. Exxon, BP, you can have a smaller proportion of those firms than you are of the bigger companies. But that's it. Essentially, on the equity side, you buy a small share in each of the companies, and that gives you the right as an owner to participate in the future earnings of that company. It gives you the right to enjoy, the growth and the future earnings of that company through time. And on the bond side, you're effectively, if you buy a bond, you're effectively lending to either a government or a corporation. You're effectively buying debt. So in essence, you're lending rather than buying. And in return for buying those bonds, in return for lending your money, parting with your capital, you get promised an interest rate, an annual interest rate, and then your principal, the amount that you lent at the start, is returned to you at the end as well. If you buy a bond and hold it to maturity, in a bond fund, it's slightly different. You're not holding to maturity, but effectively, you're lending to companies and corporations, or you're buying a small share in each one of the global companies listed around the world.
Yeah. I mean, I think we regularly try to, certainly with meeting our clients, we'll regularly say to try to think of their portfolio as that, if you like, as the great companies of the world that are producing real goods and real services to real people at the end of the day. and their pensions and their ISAs or other investments are simply just that gateway, if you like, into owning a little bit of these great companies of the world, and that over time, if we believe that great companies will continue to exist, that we can share in their fortunes. So, I suppose one of the challenges, you and I know that volatility is a characteristic of markets, and you and I would also know, we'd agree that volatility is in many ways is the admission price. If you want the returns, but actually, let me go back one. I'll go back one. When we say that markets work reasonably well, I mean, what does that imply about trying to outguess them?
Markets working well is quite an sort of abstract point to get your head around. It's like, what does it mean that a market works well? And this is, if you've not heard of Eugene Fama, listeners, and you're interested in investing, you should definitely go look him up. Eugene Fama is a Nobel Prize winner. He is known as the father of modern finance. He's done all sorts of amazing work in the investment space, but one of his kind of key hypothesis, if you like, is called the efficient market hypothesis. And what it essentially says is that market prices effectively reflect all known information. They have all known information embedded in market prices, and that is it's an impossibly, you can't prove or disprove that statement. It's not a scientific statement, if you like. It's impossible to prove that with certainty. But what you can do is try and observe some things that you would expect if market prices effectively reflect all known information. And what we can try and do is think about what that actually means. So if a stock, price reflected all known information, then the only reason that stock price should move in the future ought to be the release of new information, new unknown information, and that is a by definition random process. And through time, we have market events that happen all the time, whether it's earnings announcements about a company, whether it's a global superpower in deciding to invade a small country in the Middle East, whether it's a pandemic, whether it's whatever it might be, tariffs. There's all sorts of new information being priced in all the time to market prices. And market efficiency just says that everything we know now is already embedded in the current market price. And therefore, one thing you'd expect to see, if that were true, or at least a reasonable approximation of the truth, is that it's very, very difficult to profit from second guessing market prices. Like, it's very, very difficult because you're effectively betting against a random process. It's much more akin to going to the casino rather than what people think it is, which is investing through time and expecting to beat the market. So hopefully that gives you an idea.
Yeah, and you said that earlier, didn't you? That there's so many participants in the market that's really ultimately deciding the prospects, or how well a company is going, or a share is going to perform. So, to try and undermine that seems to be futility, really.
Yeah, and exactly. And one thing that I think investors struggle with sometimes is that market efficiency doesn't mean that the prices are perfect. It doesn't mean that they're absolutely bang on to what the true, unobservable intrinsic value of each company is. It just means the errors, whether it's slightly high or slightly low, are by definition random. And if they're random, if this price is slightly too high, if this one's slightly too low, if this one's way too high, if those errors are random, it's incredibly difficult to profit from them. So it's market efficiency is quite abstract. It's not, we can't prove it with certainty, but one thing we would expect to see if market efficiency was broadly true was that it'd be very, very difficult to beat markets successfully, consistently through time. And that is observed, wherever you look, as long as you've benchmarked, that cohort of active managers properly, on average they do pretty poorly before and after costs.
Over time.
Exactly, yeah, over time. In the short term, maybe you're going to have some that sit in the right side of the distribution because they happen to be in the right place at the right time. But if you're looking over any meaningful time period, 10 years, 15 years, 20 years, there's nowhere to escape. Markets just do what markets do.
Yeah, and it seems to be that those managers that are trying to to beat the market or beat their benchmarks and are taking that judgmental or active approach to buying and selling shares in the great companies of the world, it seems to me that those that the studies seem to reveal very clearly that those that have a period of outperformance, it tends to be short term. It might be a couple of years, it might be 3 years, but yet that outperformance doesn't follow in the following 3 years, if you like. It's like they fall off a cliff, and which goes to show that it probably was just the outperformance was probably just down to luck, perhaps, and not skill.
Yeah,
they would like to say.
Exactly. Yeah, I mean, it's obviously not. Certainly don't want to sit here and really bash the other side of the industry and say it can't be done. It certainly can. The likes of Warren Buffett, of Jim Simmons, of Peter Lynch. We know the names, and that's the crucial point. We know who they are because they're one in a million. They're one in 100,000, and by the time they've done what they've done, it's often too late for the vast majority of investors. And for every Warren Buffett, there's hundreds of thousands of people we don't know because they couldn't do it. So as I said, what's happened has happened. What's important is what's going to happen in the next 20 years. And you need many years of consistent outperformance to be mathematically sure that what you're looking at is skill and not luck. Someone like Warren Buffett probably passed that test. A Cathie Wood, for example, again, not to say that she's not really intelligent and great at what she does, but those sort of few short years where she absolutely hammered the market, it could be that she's highly skilled, but it could also be that she was just lucky and she was in the right place at the right time. You need that. You need sort of 20 odd years and beyond really to be mathematically sure that what you're looking at is skill and not good fortune.
And I suppose that the other aspect with all of that is that to the consumer who looks at Best Buy tables and the Sunday papers or whatever, and they see the top funds, what they're not maybe seeing, of course, is what level of risk has been taken by that manager to achieve that return, and it could well be that actually that specific fund manager has just called it lucky with small companies or value companies at a period of time, and they've managed to get that outperformance. So risk-adjusted returns would surely have to be a big part of that, wouldn't it? If there has been a bit of outperformance.
Definitely, and that's one thing that we have learnt in the systematic space through the decades is, just because we think markets are pretty efficient and therefore difficult to beat, doesn't mean we don't have choices as an investor. If markets are pretty efficient, then all known information is already captured in the market price, but that doesn't mean that every stock is made equal or every bond is made equal. There are the evidence through time has evolved, and as I said, Gene Fama earlier, there's Ken Frentz, there's Robert Novi Marks, and many others, Bill Sharp's Original Cap N. There's many others in the academia that have consistently looked at asset pricing models through time, and they've essentially come up with frameworks that say, well, look, the market's pretty efficient, but that doesn't mean that different group of stocks don't behave differently. And what you've settled on there, Jonathan, is size and value. Smaller companies and relatively cheap companies tend to behave differently to their counterparts, the large companies and the more expensive companies. Same with profitability. Higher, more profitable companies behave differently to those that are less highly profitable. So that's us effectively doing that process I said right at the start, which is it's using the market price to say, what do we expect tomorrow, rather than saying, what do I think, what do I think is going to happen tomorrow, and then comparing it to the market price and effectively disagreeing.
Yeah, yeah, and I touched on this earlier that that term risk and return are related. I prefer to refer to that as volatility and return are related. In other words, if as an investor we're wanting higher expected returns from our portfolio, which is made up of pensions and ISAs and so forth, if we want those higher expected returns, we have to accept that with that comes higher volatility. What's important from your perspective? What's important to understand about this, James?
So volatility is, and I think you're absolutely right to call it volatility, not risk. It traditionally was used interchangeably with risk, but volatility is a risk in investing. It's the one most people anchor to. Volatility effectively captures how much your portfolio is kind of going up and down through time. A good rule of thumb, if you've got a volatility of 10% and say an expected return of 5%, then 2 in 3 years your return's going to be 5 plus or minus 10, and then in that third year you're going to be outside of that region. So that's kind of the rule of thumb. So you can imagine straight away, if you've got a volatility of 20 and 2 in 3 years are going to be 5 plus or minus 20, that you're wiggling about much more than the sort of 10 example at the start. So volatility is a risk, and it's a key risk. But what you're essentially trying to do when you build a portfolio, or at least when you think about building a systematic portfolio, is one of the things you can do is maximize your volatility adjusted return. So you said right at the start, Jonathan, that diversification is your only free lunch in investing, and that is absolutely true. If you can find asset classes, if you can find groups of stocks or investment opportunities that have a positive expected return, that you have good data for, that you have an economic reason for why there's an expected return there, there's robust products. If you can meet all of those hurdles and then putting them in a portfolio alongside whatever else you've already got in that portfolio, gives you a diversification benefit, i.e. some are going up while some are going down, and then they kind of keep crisscrossing with one another. What you're effectively doing as the investor who owns both of those asset classes is you're enjoying a much smoother ride between, in the middle. You've got, all different investment opportunities zigging and zagging, and you're enjoying a much smoother ride down the middle of that. And that'll be what your portfolio looks like. There's a key benefit to what I said earlier, that the risk factors, that the likes of value and profitability and small caps, they are stocks with higher expected returns, but almost more importantly, they are areas where you can diversify and improve that volatility adjusted return. You can earn either, a similar amount of return for lower volatility, or you can earn higher expected returns without materially raising your volatility. So that's where we're going with some of the construction approach, some of the elements of the construction process that we look at with our clients.
Yeah, and I think it was a wise man once said, when it comes to investing, 3 things matter: diversify, diversify, diversify. I'm sure, but once you've accepted those 4 beliefs that that capitalism creates wealth, and that markets do a pretty good job of giving us a return over time, and that volatility and return are related, and that diversification is that free lunch when it comes to investing. I think it's important that we maybe talk a wee bit about what we mean by that, because it doesn't mean that you invest in everything that's available. That's available. I think in our last investment committee meeting, or looking at the investment process, there's about 21, 22 different asset classes available to invest in. And then in exactly the same way as making a cake, you've got to start with the right ingredients. We need to know the right ingredients. And I suppose, out of the 21 asset classes that seem to be available to an investor, you have what we call our defensive assets, which we tend to think of as fixed interest or bonds, which are loans to governments, loans to corporations. And then we think of growth assets, which we probably think of as shares or equities in the great companies of the world, including developed market equities, emerging market equities, and small companies, and lower price value companies, and so forth. And then there's all these alternative assets, which include crypto or private equity, hedge funds, and so forth. From Albion's perspective, what's the criteria, James? What's the important criteria that we need to be thinking about before? And this is really for our viewers and listeners. What's the important criteria for an investor to be thinking about before they include an asset in a portfolio?
Yeah, it's really there's many elements at play essentially, and I touched on some of them earlier, but we have a pretty rigorous framework for asset classes to meet that hurdle of warranting a place in the portfolio, and that's Albion's view. It's not prescriptive. We give it as a sort of starting point for all of our clients, and that's the part of the induction process, is for our clients to kind of make their own mind up on these things. We have our view, and we present the latest and greatest evidence, and then our clients kind of choose to go one way or another, and we help them make that decision. So we have six criteria within our asset class analysis that we update each year. There needs to be an economic rationale for where the return comes from. There needs to be adequate data insight. And adequate data insight is not 5 years, 10 years, it's decades, if not centuries. There needs to be robust products available to us. There needs to be a place in the portfolio for it. So we need a role in the portfolio. That's a really key one. We have to be able to, we've got to ultimately come up with a portfolio, and to put something in, you have to, by definition, take something out. So, that's always a key thing that's missed here, is if we want to add more in value stocks or in real estate, say, well, that has to come from somewhere. So what are we dialing down to get from A to B? And that's something that investors miss all the time. You've got to take something out to put something in. And then there needs to be the risk management process, the ongoing risk management process needs to be doable. And that's another one as well, which is often forgotten. So something like, the hedge fund universe, say, there might be elements of, things like trend following strategies or managed futures. I won't go into what they are, but there might be elements of the hedge fund world that have sort of got some quite compelling evidence behind them. But the problem is, if the risk management process involves spending hundreds and hundreds and hundreds of hours to satisfy yourself that this is the one, and even then you can't be, sure. You can't be sure that the manager you've selected is the right one. You're going to spend all your time on that process rather than focusing on the really important things. That's like the financial planning side of your client's business. So the risk management needs to be manageable. And then finally, there needs to be robust products available to us. So something like profitability that I mentioned, or short-dated inflation-linked bonds, say, those are two asset classes where we really struggled for product in the past, and innovations from the likes of Dimensional, of Avantis, of iShares, Vanguard, and others have opened up asset classes through time, because they've ultimately launched products in different spaces. So that's the criteria, and we update the research for all of the asset classes that our clients effectively know about each year, and it's a really fun part of what we do. I would probably say most people will hear that and be like, sorry, what? That's fun. But we love it. We absolutely love it. So yeah. hopefully that's useful.
Very useful, and I think this point, I suppose, like making a cake, and you've decided on, right, here are the ingredients we want to use to make this cake. Then there's a question about how much of each ingredient do we need to make this cake, or how much of an asset class do we need in this portfolio, and are there ingredients that we could include but we're not sure whether to include? Is an important one, I suppose. How do you, from Albion's perspective, how do you decide, what not to include? Even from your perspective, James, what are the sort of red flags for you? You talked about the 6 criteria, economic rationale. Is there one of those 6 criteria which is just a big no-no? If it doesn't have that, it ain't going in.
Yeah, it's good question, and it's an interesting one, because this is where it's not black and white, right? Because I said at the start, there's sort of these 2 camps: systematic and judgmental. Sometimes that's referred to as passive and active, or index and active. And the reality is it's shades of grey, and we can science the investment side. We can number crunch till we're blue in the face, but we've got to make some decisions at some point, and ultimately it's going to get to the point where those decisions are driven by preferences. So interestingly, me, my colleague Ben, Dan, Tim, we've been at this for Tim 25 or 30 odd years now, me and Ben and Dan for a decade or more now, and our portfolios all look slightly different. They've all got the same ingredients, as you say, but I might have more of one ingredient than the other, and Dan might have a gone down a different route and chosen a different fund. Ben might have done something else, and they're driven by preferences at the end of the day within a very rigorous and robust framework. Ultimately, the question is always, what mix of risks do you want? That's the key. It's risk. You've got our risk hats on at all times. It's what mix of risks do you want? What mix of risks are right for you, the investor, to make you feel comfortable and meet your financial goals throughout your life? That's the absolute key. So what? And you mentioned which criteria are sort of absolute for me. I'd like to say them all, because they are all really important. But economic rationale, I think, is a huge one. I think there's lots of asset classes out there that have got exceptional returns through time. There are 30-year periods, say, that you can look at gold and it looks fantastic. Same with, say, long duration bonds. Same with cryptocurrency, I guess, back to 2009 now with Bitcoin. You can look at the returns and create an economic rationale around it. But I think if you start from first principles, something like gold, something like Bitcoin, just as an example of those with good returns, falls down quite quickly. So economic rationale is huge for me. I think it's where it should start. But there's obviously the others are all important as well.
Yeah, and it is. You're absolutely right, because even on the defensive side of things, there could be a temptation. You think of emerging market debt, emerging market bonds, and we know that we just need to look back at during the COVID period or the financial crisis or the tech bubble at the start of the millennium to see that some of these asset classes start to behave more like equities during these periods, and these are the sort of decisions that need to be considered, don't they?
Definitely. It's really, I think people get to things like emerging market bonds and high yield bonds, and I think they think about them they think about them with the wrong hat on, effectively. They're not thinking about their risk hat. So our defensive assets, as you mentioned, what's the goal of our defensive assets? It's not, return isn't our primary driver there. That's in the growth assets. We're thinking about, how good or insurance policy are these asset classes? Are they going to be there for us when our growth assets are misbehaving? Are they going to be able to match our short-term liabilities, those things that are happening in the next 3, 5, 7 years for us, with near certainty. And when you look at the goals of the defensive assets, something like emerging market bonds or high yield bonds, they fall down very, very quickly. And actually, they're growth assets. They're not defensive assets. They're growth assets, and therefore, if you're measuring high yield bonds, emerging market bonds against equities, they're always going to lose on an expected return basis. So, that portfolio role then becomes meaningless. You're taking out highly diversified portfolio of equities and replacing it with emerging market debt. So, yeah, it's a good point, Jonathan, and it's always having that risk-based hat on, and risk and goals-based hat on will really be the key to guiding you through these decisions.
Yeah. And, you and I have talked about it before, and perhaps clients or investors, people watching, listening to this podcast have probably heard, or maybe heard, that asset allocation is a key driver of returns, and more so it's asset allocation that matters rather than trying to, stock pick, if you like, and build a portfolio with a small number of equities that you've made judgment to invest in, or decided that you should invest in. But why is owning thousands of companies across different regions and different sectors, why is that so powerful, James?
It's because ultimately diversification is your best friend in investing. And there's a really good exercise we do at Albion, and every single year, without question, if you're a reasonable sized investment manager or asset manager with products out there, you probably release a market outlook for 2025, for 2024. You can go back through time and look at them. Go back to the end of last year, set that criteria on Google, or ask ChatGPT these days to say, find me these 10 managers market outlook for 2020 for 2026. Save them somewhere, and then at the end of 2026, go back through them and look at who was correct and who wasn't. Almost by definition, half of them are right and half of them are wrong, because markets work pretty well. And so those views are already embedded in the market price through time. So, one of your key tools, particularly in the short term, is being highly diversified. And you only have to look at, the last few calendar years to see that. US stocks have been the driver of returns for some time now, since the financial crisis. The likes of the big tech companies, the Apples, the Amazons, the Teslas, they have dominated markets for 15 years. But, in the last couple of years, it's been emerging markets that have really taken the throne. Start of 2025, emerging markets absolutely dominated last year, and again they've had a great start to this year. So if you're not highly diversified and you don't take that really highly diversified risk-based approach, you risk effectively missing out on the winners of tomorrow, and anchoring yourself to the winners of yesterday. And I will just say, a really nerdy but cool exercise is, we have a chart at Albion that we really like, which is the top 10 stocks at the start of each decade. We've got a few more years to wait to update it for the next decade, but you go back and look at that from the start of 2020, and it is big tech. You go back 10 years before, and it's a mixture of big tech and some other names that have kind of whistled away. You go back to the start of 2000, and it's different names. You go back to the start of 1990, it's the banks and the energy firms. 1980s, it's Japanese stocks. So it changes so much through time, and you only have to go back 20 years, and Facebook was basically in its infancy. Google hadn't really listed yet. Amazon was a bookstore. Tesla didn't exist. Microsoft was out there. Microsoft was probably the exception. Apple was something like 400th in the Fortune 500. Those companies, we need to identify them today. And the way that you guarantee that you're going to benefit from whoever those companies are over the next 20 years is you start by being highly diversified.
Yeah, yeah. So you're not left behind, as it were.
Exactly. I probably went off on a few tangents there, so sorry about that.
No, that's okay. No, absolutely. I think there's a, that matrix where you see, the chart that represents the developed market of 25 countries or so, and you go back 20 years, and at the top of every year, you can see, the top performing country in any years just seems to be different for a 20-year period. And looking at the chart just looks like a patchwork quilt because each country is represented by a different colour. And it's the same for emerging markets. I think there's 21 countries or so in the emerging market space. And you look at the 20 years, and again, there's just no way of determining which country is going to be the top performer or above average performer in any one year. And you just need to be diversified. It's as simple as that. And I think actually it's those sort of charts which explain or highlight the importance of diversification and actually the futility in trying to speculate. Certainly in my humble view, Tell me,
one of my favourite charts, that one.
Yeah, I mean, tell me, James. I mean, we talked earlier about, Wells Gibson. We're strong advocates of systematic investing as opposed to active or judgmental investing, and for good reason. We really do believe in the structural integrity of the portfolio. I remember when I started on this journey, when my eyes were opened to the world of systematic investing and being told three things matter when it comes to investing, Jonathan: diversify, keep costs down, and ensure you only take risks worth taking. And in other words, make sure your portfolio is characterised by, if there is extra volatility or potential volatility in the portfolio, make sure that that's worth taking. And we've talked about small companies compared to large companies and lower price value companies as opposed to higher price growth companies. Take the risk worth taking. But focusing on cost alone, just for the viewers and listeners, why is this so important over a long-term period, say 20 years? And does being systematic reduce that unnecessary friction?
Definitely. That's a key part of the two sides of the industry, or a key characteristic of the two sides of the industry, is keeping costs low. And you will tend to find on the judgmental side much higher costs. Like, it's a more hands-on approach. You've got more, big research teams crunching the numbers all the while, and you're paying for the latest and greatest machine learning algorithms, the AI trading platforms, all that good stuff, and that has to be paid by someone, and ultimately that's paid by the end investor. You don't have a lot of that on the systematic side. Index funds and broadly systematic funds these days, you can really build a very highly diversified, sensible portfolio for 15 to 25 basis points, 30 basis points maybe, depending on your preferences. So costs matter. Jack Bogle, the late great Jack Bogle, said you get what you don't pay for in investing, and he's absolutely right. Costs are a definite. They're one of the few certainties about investing. So having a very tight focus on financial costs and emotional costs of investing your portfolio is key. And I will say, despite that, costs aren't everything. And that's, again, where I think the systematic side of the industry can fall down sometimes, because it's very much become a race to the bottom, and trying to shave a basis point here or there to be the lowest OCF on a list of funds. when someone goes away and does a robust screening process, you're looking at a list of highly diversified, really top quality index funds. Everyone's kind of racing to be the lowest cost because they know that, people build a portfolio and they report the OCF figures to end clients, and the lower the number, the better. The reality is it is so much more detailed than that. You can look at 3 index trackers with exactly the same cost, and they will have pretty vastly different outcomes because of where they're domiciled, what are the tax consequences, whether it's an ETF or a fund, what does the securities lending policy look like, and how much of that revenue is given back to investors. I'm talking about things that are probably far too technical here, but that's why Albion exists. We do that work, but ultimately you can end up with 3 index funds that have all got the same price, and they've all got, say 20 basis points differential in their returns, so dwarfing the OCF number. So costs are important. It is crucial to have a focus on costs, but they are not the be all and end all. And you have to have that extra layer of detail when you get down to choosing the best of the best, specifically for your clients.
Yeah, and it's probably why when we've coming back to that analogy of the cake, and we've picked the right ingredients, we've decided we want global equities in our portfolio, and we know how much of global equities we want in our portfolio, or emerging market equities for that matter, that we then have to make sure that the funds that represent that asset class are best in class, and costs will play a part in that. So it is a rigorous process, isn't it?
Yeah, it's sometimes you're sort of going down to the minutiae and you're really looking at it and kicking the tires on it, and it can be a really small decision one way or another. So, but yeah, I can give you, if you good anecdote, like we were talking about the patchwork quilt earlier. South Korea was top last year, and they're currently top again this year. They're up something like 200% in the last 18 months or something crazy like that. So South Korea is defined as developed by FTSE, which is a big index provider. People will have heard of the FTSE 100, but it's classed as an emerging market by MSCI, which is another big index provider. So that's a really subtle nuance where two index funds, one of them's got South Korea in it because it classes it as a developed market, and that's been up 200% in the last 18 months, and the other one hasn't because it classes it as emerging and it's in the emerging markets fund. So you've not got that really detailed look at your portfolio in the last 18 months. A FTSE MSCI developed emerging portfolio looks so different to an MSCI FTSE one because one's doubled up and one's missed out completely. So that's where the screening process that we run with you, Jonathan, and with others is absolutely crucial to really get down to that minutiae and make sure clients are at the heart of those decisions.
Yeah, absolutely. And now thinking about the investor, because we've often said that an investor's his own worst enemy. What's the after managing costs and being clear about the funds you're using in a portfolio, the next big risk to us all is how we manage our emotions, isn't it? And what do you see as the biggest behavioural mistakes that investors make?
We are ultimately our own worst enemy. It's so true, Jonathan. And no matter how much you read and are passionate about investing, and you absolutely love the nitty-gritty details, I can tell you at Albion we've got a room full of people that love it at all times. Until you've been through a material market crash that we haven't seen in some time now, until you've been through a material market crash, you really don't know much about yourself as an investor, and it's a huge part of what a good financial advisor like yourself does with the end client is keeping them on the plan, keeping them focused on those beliefs, keeping them focused on their goals and preferences, because at some unknown point in the future, the stock market will it will tank. It will go down 30, 40, 50% maybe. And you will be left with a portfolio that suddenly lost a huge amount of your life savings. Now, the key is you've not lost anything. You've not lost anything because you don't need that money now. That's why you're investing it. So you've not lost anything till you sold. And that's why you've got your defensive assets there to protect you during those times. But there will always be, and there are, a non-zero number of investors that will get to that point in time and they will sell, or they will go to the next best thing. They will be, they will be sort of wowed by, the sort of shiny beauty parade of an active manager, and they'll move their money. And ultimately, as a cohort of investors, we buy high and we sell low on average, and that's why when you look at the average investor returns versus the market returns, they're always pretty much behind by, depending on the market and depending on the time period, somewhere between 50 basis points and 2%. And that's what we often refer to as the behaviour gap. So those investors that can stick to the plan no matter what and only make changes when there's an exceptionally good reason to do so, a really strong body of evidence to do so, those are the ones that achieve the market returns through time.
Yeah. Time in the market rather than timing the market, I think
exactly.
is clearly what matters. James, you and I know past performance isn't a guide to future performance. The regulator would oblige us to tell investors that, and for viewers and listeners, they need to know that. Yet, it's clear that your community of clients, your 75 firms you're working with, are employing a systematic approach when it comes to investing for their clients. And your research reveals that actually these portfolios have outperformed the vast majority of UK multi-asset funds and managed portfolio services over quite meaningful periods. Is that about brilliance or just about consistency?
No, yeah, it's not. No, it's not about. It's certainly not about expert, models or superior technology or, any of that stuff. It's about doing the key things really, really well through time. Tim has a line, and I love it. I've used it many, many times with clients. But investing is simple but not easy. And there's those enduring beliefs that we went through earlier. Once you can get your head around those, you've done 90% of the work. The extra 10% around value, size, profitability, around real estate, around which funds you choose, securities lending policies, all that really technical stuff that we've also touched on today, that's going to add that extra 10%. But if you can get that 90% right and stick with it through time, then you're going to beat the vast majority of investors through time. And that's really, really powerful. And that's, Albion clients are doing that. The chop change strategy is we partner with firms that are on the same page and have the same philosophy. So there isn't any of that within the community. There has to be a very meaningful reason to make changes. And so when you compare Albion clients looking backwards to the cohort of, as you say, multi-asset funds or whether it's MPS services, there's fewer of them and you can't do the comparison quite as well over there. But yeah, it's the classic systematic versus judgmental. Systematic wins on average over time, every time, almost by definition.
Yeah, very helpful. I'm just some final reflections, James. In your opinion, what do you feel the best firms consistently get right when it comes to investing?
Focusing on the evidence and making sure that every decision really is in the best interest of the end client. It sounds simple, and it sounds like, well, surely everyone does that, but it's not the case, and we've got a long way to go, before ultimately that is the case, and so I think, the best firms focus on those things, and evidence-based investing. I think that term has become a little bit of a red herring in a sense, because people say, well, there's evidence for every portfolio, and it's like, well, there is and there isn't. I don't agree with that statement at all. Some evidence is helpful for portfolio construction, and some of it isn't. And that's the role of the investment committee to work out, as you say, which route to go down. Focus on the evidence. Put your clients at the centre of every decision. I think the best firms are doing both of those things, obviously amongst some others.
Yeah, and that's a good point you say, but the whole evidence-based thing has been used more broadly these days, isn't it? And I suppose a judgmental manager would probably agree capitalism creates wealth, markets do a pretty good job of giving a return, risk and return related, diversification is an effective risk management tool. They wouldn't argue with that. I suppose it's the practical imperative. It's what are they practically doing? If that's their foundation, what's the consequence for them, and how are they then building a portfolio? What ingredients are they using, and how are they going about doing it? And what they're doing is doing it in a judgmental way, and then increasing
Absolutely.
costs and uncertainty and so forth. Just to finish up, actually, I've actually said this to a few other podcast guests. Actually, it's only when you start getting into these conversations you actually realise we could have had a mini series around each of these points. But just to finish, James, I mean, for anyone watching or listening to this episode, what one principle would you encourage them to hold on to when markets feel uncertain?
Stick to the plan. Stick to the plan would be my guidance for anyone having a wobble when markets inevitably dip, as they will. They did it this year, earlier in the year, they did it last year. They will dip again and again and again by definition. That's why there's a return on offer there. Investing is risky, and that's why there's a return there. But you did not build a portfolio for a 6-month period or a 1-year period or a 5-year period. You built a portfolio to help you through retirement, through through the accumulation and through the retirement phase. You built a portfolio for decades, not for a short-term period. So stick to the plan, tune out the noise. Don't check your BBC News app too often. Don't check your portfolio too often, and go enjoy yourself, especially if you're in that retirement phase, because you earned it.
Yeah, thank you, James. That has been a genuinely brilliant conversation, and I say that having had many of them with you over the years, but I think what really comes through today more than anything is just how a coherent, a well-structured investment process can be when it's built on a clear set of beliefs and the discipline to stick with them. James, thank you so much for your time today. As always, your clarity of thinking is something I find enormously valuable, and I know our listeners and viewers will too.
Really appreciate that, Jonathan, and great to see you. Enjoy the golf this afternoon if you do get on the course.
You're not meant to tell the viewers and listeners that, but thank you, and thank you to everyone. Thank you to everyone for listening or watching. If you've enjoyed this episode, please do share it, and if you'd like to learn more about how Wells Gibson approaches investing, or even if you'd just like to have a conversation about your own financial plan, you will find us at wellsgibson.uk, or simply get in touch directly. And until next time, keep thinking long term. Thank you.
Thanks so much, everyone. Thanks for tuning in.